You don't need $50,000 to start investing in real estate. In fact, most of my early deals required way less. So in this video, I'm going to talk to you guys about 5 quick options that you can get into for less than 50,000. Again, it's going to scale if you're buying $1 million, $2 million, $3 million, $4 million homes. That's going to change the maths a little bit. But for most of us, you can get in for less. You don't need $50,000 to buy your first property. Most beginners wait years because they think they need huge savings. But the truth is, people are buying their first property with just $8,000 to $15,000 using beginner-safe paths nobody explains properly. If you want to learn the simple roadmap beginners use to get started, I'm teaching it in a free workshop. Tap the link and save your spot. So here's the first option. First option is the FHA, or Federal Housing Association loans. Now, with FHA, you can get in for as little as 3.5% down. This is great for house hackers. Now, by the way, this is not if you're basically buying a property that you're not living in. You cannot do this. But if you're going to live in a home, and by the way, just live there for just over a year, after that time you could move and then you can convert that into a rental property. So the intent is you go in to live and then down the road you can move. You have to have an excuse, maybe you got a job change, etc. But honestly, like after that, for like if you rent, you can just move out and rent, but you've got to live there for the first year. So just keep that in mind. But that's absolutely incredible. And it doesn't require huge credit. In fact, with just about 580 credit points, with that score, you don't need 800, don't even need 700, not even 600, right? So just 580, and you should qualify for 3.5% down FHA. Absolutely great for house hackers. So if you want to kind of buy a duplex or triplex or a quadplex, fourplex, you can get tenants to live in the other units while you live in one, and they pay your mortgage down for you. Right? Or you could live in, if you just buy a single family home and you have lodgers, renters that are room renters that are living in the other bedrooms. And so you buy a 2-bedroom or a 3-bedroom, then the other people living there, right? You can get lodgers again, you can get renters to come in and share with you, almost like having roommates that subsidize the cost of your mortgage. Maybe they pay towards utilities. Maybe they give you also some extra money towards the mortgage, 500, 1,000 a month, whatever it is, it'll help you. And again, you can get in and do that if you're living there and having the tenants. This is absolutely brilliant for small family. If you're looking for 5 plexes and above, this doesn't apply, but for 4 units and less, this definitely applies. Second option is if you've got a little bit stronger credit, you can use conventional financing. Now, there were situations where people were getting 3%. I think typically, though, 5% is the comfort zone in terms of the lowest you want to put down for this. So 5% down, amazing. If you have a little bit better credit, you'll be able to get into this. This is great for those of us that have stronger credit, really 680 and above, typically speaking, for really strong. You're going to find that it'll be hard to find a lender that won't do it for you in that case. 740 is usually the highest, like above 740, you're just showing off now, right? It's just ego. Getting all the way to 850, even though no one really has 850, but all the way up, doesn't really affect anything after 740. Interest rates don't really come down. It's more to do with buffer. Like if something negatively happened to your credit, you can afford to take a shock down to 740, but above 740 is not going to help much other than that. So that conventional down 5%, that's what I'm doing right now on my fourplex property. I've also I was a 10% down on a duplex property. I've also done 5% down on my first single family property. So it's always conventional for me. Why not FHA, you might ask? Well, FHA is great if you don't have good credit, but it comes with what's known as MIP, which is kind of like a mortgage insurance premium, which you have to pay for the life of the loan. That could be 30 years. Now, you can get rid of it if you can get rid of your loan. So in other words, if you take out another mortgage that pays off your FHA mortgage, that's one way of getting rid of it. Whereas for conventional, which is what I was doing, I had a bit more credit, I pay an equivalent, rather than MIP, I pay PMI, which is private mortgage insurance. Now, I say I paid in the past, because the great thing with PMI is it basically goes away after a certain number of years once you've paid off a certain percentage of the property. So once you get typically to 20% or more, you can get rid of it. Now, certain lending institutions, it'll basically require you to maybe even have more. Sometimes they want you to have 25% or more. It really depends, but 20% is usually the ballpark. So again, once you own at least 20%, so you've paid it off, or here's the trick, if you have significantly increased the value of your property, typically through rehab or renovation, right? So doing some reno on it, right? That's what I did in my properties because I was buying fixer-uppers. I renovated them. You know, my first property, just a few months later, after renovating the property, it appraised for almost $100,000 more. And I got the PMI taken off. Now that PMI, by the way, it's only usually, you know, a fraction of a percent to a little bit more than a percent, depending on how little you put down. If you put down like 5% or 3%, you're paying kind of way over 1% extra, right, in terms of the PMI. Versus if you're putting down, let's say 15%, which is almost 20%, you're only paying a fraction of a percent at that point. So for me, it was just, you know, $200-300, something like that a month. I think it was the first property wasn't even $200. The next property was around just over $2. Right now, in my fourplex, I'm paying about $278 a month. Now, that might sound a lot to some of you, but I would have had to come up with something like $170,000 as a down payment, rather than just $46,000. $46,000, I don't know about you, but that's a lot less to have to save than $160,000. So I'll pay that $278 for the next few years, rather than having to wait until I've saved up $160 or taking it out of stocks or elsewhere. So if you're trying to get in cheap, conventional is a great thing for those of us that are strong credit buyers. Now, a third option, this is more advanced, is seller credits. This is just asking the seller when you're negotiating, you know, hey, just wondering if you're willing to basically do the deal through seller credits. I would like to get the property, but, you know, the actual closing costs are killing me. You know, they're going to kill the deal. I can't really afford to pay them, because the closing costs are in addition to the down payment. The lender and otherwise, etc., appraisal fees, you know, the lender's fees, the underwriting fees, all these kind of things. These are costs, usually 1 to 5% of the property we're kind of looking at there in terms of fees. So that can be quite a lot, and you can get the seller sometimes in negotiation, if the seller is willing to do this, right, the seller really wants to get rid of the property, then they'll basically offer to pay your buyer closing costs, and that makes it cheaper to get into a property. Also, negotiating repairs. When you're in inspection under contract, if you do a home inspection, if you haven't waived that contingency, then you might discover there's certain issues that have to be addressed. And you might be able to negotiate with the seller, where the seller will agree to basically to concede and to fix those things, or give you a check afterwards so that you fix those things. And this certainly reduces the out-of-pocket on day one. In addition to installment grants and all that stuff, local things like that, this definitely helps you, seller credits and negotiating repairs. Now, a fourth option to get in cheap. Now, this is more, I kind of look at this as afterwards. Like, this is kind of after you have one property where you're living in it. So when you live in it and you own a certain percentage, when you kind of have raised the value, or you've already put a lot of money into the property, or it's been a few years, you will now own more of the property, and you can take out a home equity line of credit. So in my first year, I was able to do this, even though I only put down 5%, because I remember I put the money into the property, I rehabbed the property rather, I fixed it up, I gained $99,000, and I was actually able to take out $68,500 to be specific, as a home equity line of credit. And this was like, for me, it was like writing checks, or a credit card essentially. But for me, I had a checkbook. So I could write these checks, pay interest only for a certain number of years, draw period, and then I had to pay it back. Or I could pay it back really quickly. So this is very good, because in my second property, I was writing these checks rather than tapping into my investments, my index funds in the stock market, rather than selling stuff and, you know, incurring the tax on the capital gains and all that jazz, and just lack of compounding and missing out and all that. I said, you know what, I want to write using my checkbook for my home equity line of credit. So you can use this, you can use equity safely this way because you're using your first property or the property you're living in or have lived in the past, you're using that as collateral for the bank so that you will owe the bank, right? But again, follow this, check this out, the institution that gives you this opportunity so that you're not going to be in the red. Now, these are typically not callable loans, so you will be told this is the amount of time you have to pay back, this is the minimum you must pay, etc., etc. But HELOCs are great. They're great when it comes to renovations. So it could be the case that you've got into one property, you don't have the money for renovating a next property, but you got a HELOC, and you know in time you'll be able to make the money to pay it off. Then the HELOC can be, for those who are more advanced, this can be a great strategy. This is what I've done in the past. I love it, absolutely love it. Now, when you're not living in a property, check out a rental line of credit. That's a separate thing. Now, a fifth option for those that want to get a bit cheaper is partnering on a deal just to get into the game. This could be like the very start, or it could be later on in your journey. Now, this is where you are more the sweat equity partner. So you're the one that's finding the deal. Maybe you're the one that's negotiating, doing a lot of the work in terms of the rehab. You know, you're basically kind of the active partner, the general partner. They're more limited partner. They're more kind of the money partner. So there's a lot of money out there in the world, but there are less deals. So if you're the one that's willing to find the deal, you'll find plenty of people out there, believe me, that are willing to give you money. They're too busy. They don't have time, but they have money, so they can give you the money. If you have time, you have either the skill or the time. Sweat equity counts. This is great when you're starting off. If you're working on improving your finances and you're wondering what the next step could look like, I am hosting a free workshop that shows a simple, beginner-friendly path to buying your first property, even if you don't know where to start. If you want clarity instead of overwhelm, you can join using the link in the description. Just to reframe this though, you're not buying a home, guys. You're really acquiring a cash flowing business when you're buying properties that you plan on turning at some point into rental properties down the road. Now, you may not plan going in, but you're able to, because all properties pretty much can be turned into rental properties down the road. The minute that you move out of them, or even if you're living there and you're house hacking, maybe you've got some renters that are kind of in the place, lodgers, etc., then you're already into a cash flowing business. So it's not just a home, it's something more. And what I'm going to do, I'm going to show you the maths and the pathways that you can choose in my live training. Totally free, even if you're starting small. So guys, you don't have to do this all at once and adopt all these strategies. And you don't have to get lots of properties all at once. You can do this one at a time. So let's build your wealth one property at a time, and I'll see you in the next one.